Hi, our webinar audience and podcast listeners. This is James Kandasamy from Achieve Investment Group. Today, we're going to have another series of our educational webinar. And I'm happy to bring Eddie Wilson, and he's going to be talking about how to make millions buying and selling businesses. And Eddie is also a big real estate guy. So, I would say buying and selling businesses while doing real estate. Eddie is a friend, is a mentor, and is a very successful person. And I think all of us are going to be learning a lot of things from him. And I just want to quickly introduce who I am. And after that, I'm going to be passing the presentation to Eddie. So about Achieve Investment Group, which are James and Shanti, which is myself and my wife here. We are deal sponsors or syndicators focusing in Austin and San Antonio, Texas. We currently have almost 0.5 billion asset under management. Right now, it's like around 0.3 billion or 300 million because we sold quite a number of assets last year at the peak of the market. We have managed up to like 4,000 units, 19 apartments. We have raised almost like 80 million. This is a bit outdated number, 65 million. So we raised almost 80 million just by ourselves. We have around 1,000 units under development, around 300 plus under construction right now in San Antonio, Texas. And we have 3 or 4 projects which is going through entitlement right now, which will be hopefully ready for construction next year, right, when the market become better. We also vertically integrated. We also do our own asset management, construction, property management. We raise money ourselves. Author of 2 best-selling book. I don't know. The Rate book, which is very popular. We have sold almost like probably 10,000 copies. A lot of passive investors use that to get started in passive investing in commercial real estate or any other syndication. And I've also launched a new book, which is called Smarter Doctors, which is very specific for doctors. So if you're a doctor, you want to get that book. But both books are awesome books. I recommend reading it. It's on Amazon. You can go and get it. Just look for my name, James Kandasamy. We also have our own Facebook group, which have almost 20,000 people. So I would, you can see a lot of me in there. At the same time, just through LinkedIn, join us through LinkedIn. We have our own YouTube channel, and I also have my own Instagram, all under my name, James Kandasamy. So, and this is our website, achieveinvestmentgroup.com, and there's a QR code over there that if you want to go to our website and check us out, you're welcome to do so. So without due delay, I'm going to pass the mic to Eddie. Eddie, I'm going to make you a host, and you can start share your screen.
That's great. Awesome. Excited to be with you guys today, and we're just going to jump right in, and I'll give you a little bit of a background. Let me share my screen here. All right. Let's make sure everyone can see my screen.
And Eddie, I'll be asking questions throughout the webinar as well, because we also be converting this to a podcast format. So the podcast listeners also will be enjoying it. So go ahead.
Awesome. And thanks so much, James. Obviously, a huge fan of James. And if you've been following James for a while, I encourage you to continue to follow. And if you haven't read his books, for sure, read these books. I have been connected to James, and he said I've been mentoring. I've been mentoring more on the business side. He and Shanti and his group there in Austin. But as much mentoring as I do on the business side, I think he mentors me on deal structure side. And James is one of the go-to people that I know that are in my network when I'm looking at especially complex deal structuring. He is always on top of the game, and I appreciate everything you've done for me, James. So let me just kind of jump in and give you a little bit of a brief introduction so you have context for what we're talking about today. So today I have a private equity firm. This private equity firm is called Collective Influence. That's what you see on the screen there. We're up to about 17 assets right now that we own. These are companies with employees. They're either service-based companies or product-based companies. And we are constantly buying and selling. But the story is a little bit different. This is my current partner, Andrew Cordell. This is the two of us. We started this private equity firm about 18 months ago. And we started this after I had a massive exit in 2019. So in the past, up until 2019, I had sold about 86 companies, and had managed over 6,000 employees, and really had built about a portfolio of about 4,000 real estate doors. So as James said, I'm a huge proponent of real estate investing. I'm a third generation real estate investor, grandfather's real estate investor, dad's a real estate investor. And I came by, honestly, as I began to make my money, I began to put that money into real estate as well. But up until today, I've exited about 1.36 billion in exits specific to private equity or companies, true like companies that have products or services, employees, so on and so forth. This does not include the real estate exits. So this is primarily buying and selling of companies. And so as I've been buying and selling companies, I've found some formulas that I think that everyone should be considering. Now, many of you may say, well, I'm a real estate person. Why should I listen? Why should I care about private equity? Why should I care about buying businesses? And I'll make that case today. And I'll show you that there's really three parts to our financial success and our financial structure that you should be considering. And if you want to exponentially grow your real estate portfolio, you also have to have the other two in order to do it well. And then, so up until the pandemic, I had about 86 companies. I sold 76 of those. A large majority of this dollar amount came as exits in 2019. I sold 76 companies in one calendar year in tranches. So I was selling 5 or 6 or 8 at a time to private equity firms. The largest of those was a large insurance company called National Real Estate Insurance Group, NREG. Which many of you might know if you have single family investment properties, because we were the largest single family investor insurance group in the nation. And we built that from about 2013 till about 2019 when I exited. But I think one of the most interesting things that I have going on right now is that it wasn't just that period of time that was successful. Now I'm actually ramping up, and the speed is increasing by which I'm buying, creating, or selling businesses. In 2022 alone, in a 12-month period, I sold $91.5 million in assets, and I started that in February. So I actually bought or I created companies that I exited in less than 10 months to the tune of 91.5 million. And I'm going to explain how I do this and why I do this. So first of all, though, I think we need to get back to kind of a baseline of how we're thinking today.
I do have a question.
Yeah, sure.
Sorry. So you said you exited like 70 something companies in one calendar year, right? And what's the reason for that calendar year? What happened that year?
What happened in 2019 was, in 2018, I really felt like we had reached the peak of the market. I believe that the economy goes as the housing economy goes. I know a lot of people watch the stock market as a barometer. I always watch the housing economy. I felt like in 2019, we had hit a peak as I was watching kind of the contractive wave and looking at how the economy was responding to the housing growth. And I felt like we had hit a peak. And I had a lot of private equity firms that were struggling to get yield. And so they were coming after me for my companies that were performing. Once I sold one of those companies, the way that I had built them, these private equity firms, it was like a feeding frenzy. And once I sold the big insurance company, it was like there was really nothing that was preventing me from selling the rest of them. And I also felt like I was at the peak of the market. Little did I know that I'd go from, at that time, about over 4,000 employees down to about 40 within months of the pandemic starting. So it was a huge win, as I was able to exit at the peak and also not have to carry the employment load through the pandemic, especially with the insurance company. But that was really the kind of the genesis and then the zenith of what happened in 2019. Was really, I decided I would sell the insurance company because it was at the peak, and then the rest of them kind of went with it.
And why do you think in 2022 that you have been so active, and why do you think now is a good time as well for this?
Yeah, so I'm gonna jump into that in the presentation shortly, because I want to make a case as to why everyone should consider this as a methodology. Right now, there's a perfect storm brewing, and I'll explain that here in just a second. As we get like down that path, though, I want to go back, and there's a mindset that exists in investors today, and we're so bombarded by national media that it gets us to a place where we're acting outside of what we normally would act because we're so impressionable. And so I want to ask you the question, because I want to build a case for why you should consider private equity if you're already in real estate. Because to me, there's one of two mindsets you're in. You're either in the investor mindset or you're in the consumer mindset. And I'll prove that to you. Think about it today as you look at the marketplace. Are you looking at the marketplace with fear and you're looking at it with all the liabilities, or are you looking for the opportunities? Think about, your daily activity. Are you reading the news and thinking about, is the housing market going to crash? We used to have less than 2 months worth of inventory on the market. Now we're up to, in real estate, now we're up to 2.8 months of inventory on the market. It's slowing down. Our appreciation starting to slow a little. Lending is difficult. Are you looking at the marketplace through the lens of liability, or are you specifically looking for the opportunities that are presenting itself? And I'll tell you, as an investor, I never look at the downturn or potential downturns as something that's going to cause me a liability. I'm always looking for the opportunity. Let me give you a stat real quick. I've been through 3 economic downturns in my investing career. I started in my early 20s, 21 years old, with investing in real estate. And my CFO, Dave, just the other day told me that every downturn, the 3 that I've gone through, which the first one was really the .com crash, I have doubled my net worth every time in the downturn. And that's because the greatest opportunities come when everyone else is running out. So are you one that's running out, or are you sitting here ready with the intent of finding the opportunity? The second thing is are you investing specifically on the ROIs you desire, return on investments, or are you investing to try to create cash for safety? A lot of my friends have moved to these investments that they're only investing that provide a heavy amount of cash return versus a true ROI because they want that cash because it provides a little bit more safety for them. For me, investing is not about tomorrow. Investing is about next year. It's about 2 years, about 3 years down the road. Number 3, are you accumulating assets or are you accumulating cash? It doesn't matter what the market throws at you. Our goal should always be to accumulate assets. When you're accumulating cash, it should be for the purpose of finding the opportunity to accumulate more assets. I love, James, what you guys have done over the last year or so by divesting of some of the assets you have. But the strategy that you have is to essentially divest of some of those assets to accumulate cash to essentially go out and get bigger and greater assets. At the end of the day, assets have so much more value. They have tax value, they have appreciation value, they have long-term legacy value than cash does. Cash is diminishing. And so if you're accumulating cash, you're still in that concept of the consumer if the purpose or the motive behind that isn't to continue to accumulate more assets. Are you generating, and then the last point is, are you generating cash for acquisitions, or are you thinking about generating cash for savings? If you've got the rainy day mentality, you have been to some degree duped by the national media that that now is a horrible time to be putting capital into the marketplace. And I'll show you why here in just a second. And one thing that is fascinating to me, I got into a large Twitter argument with a lady from the New York Times because she said this statement. She said Warren Buffett is sitting on $180 billion, which he's actually now started to purchase. I think he has about 160 billion in cash or liquid today. But at the time that she wrote that, when I was taking her on Twitter, she said he's sitting on 180 billion in cash because he's scared of the economic marketplace. You could find it on Twitter, but my reply to her was, what human being with $180 billion in cash is scared of anything, right? Like if you have 180 billion in cash, there's very few things you're going to be afraid of in this life. Maybe death, maybe a lack of health, but you're not afraid of the economic marketplace. You have $180 billion in cash. And I went on to say, you must have never watched Warren Buffett over the last 60 years. If he's accumulating cash, it's for the purpose of doubling his net worth. In 2009 and 2010, he was sitting on about 40 billion in liquid cash, when a lot of us were licking our wounds over some of the real estate deals that we had gone wrong. He had accumulated cash at the perfect time, and he turned that into $80 billion in net worth in less than 2 short years. By 2012, it was estimated that he was worth $80 billion. He took his 40 and turned it into 80. What do you think he's going to do with this 180 right now? We know that statistically, it's impossible to get $2 billion status. This is what Warren Buffett actually said at one of his shareholder meetings. He said, it's statistically impossible to get to $1 billion status. He said, if you think about it, he said, the winds of change, taxes, the government, diminishing investment opportunities for greater return. He said, it's statistically, he said, if you have 1 million, it's statistically impossible to turn it into 1 billion because so few people do it. This guy has made a career on turning billions into more billions, and I don't think that he's afraid of the marketplace. He is accumulating cash for the purpose of increasing his net worth. What mindset is he in? He's in the investor mindset. So as I kind of jump through this and jump into private equity, let me explain to you why, because this is my methodology, is that real estate for me, while it does provide some active income, I look at real estate as my passive income bucket. I look at my companies that are generating active income as 1/3 of the financial puzzle. To the degree that I can create more active income, I can offset it. I can offset the taxation or the tax burden through passive income. And then that passive income is almost always in the form of real estate for me. The reason I have 4,000 doors is because I've generated so much active income in the companies that I'm creating, buying, leveraging, that I can play my passive income game at such a higher level. So many people make this mistake. They jump directly into real estate, and their active income has to be created by real estate. Then their passive income has to be created by real estate. And then lastly, legacy and endowment. What I do is I take all my active income. That's my private equity stuff, the things that I'm actively involved in. These are companies like we have right now, like Think Realty, which is a big real estate media platform. I own the American Association of Private Lenders, the AAPL, that's active income. Money Is, own a large fitness convention called FitCon. We have the Aspire Tour that we're putting on. All of those are active, that's all active income. I'm taking all of that active income annually and I'm dumping it into passive income streams like multifamily, hospitality, some single family new builds, some multifamily new builds. And I'm dumping it over there where it is going to yield annually more passive income. Then I move all that passive income to what I call legacy or endowment. And so I use different structures like infinite banking and others to hold onto that. But that then creates a consistent stream of passive income that moves into what I'm really passionate about, which is feeding orphans around the world and orphanages and so on and so forth. And so for me, this is the cycle of my money. So when I look at this, I realize that the more active income I can create, in the end, the more passive income I can create. And so, I have young guys talk to me all the time and they say, should I quit my W-2 job and go 100% into real estate? And I always talk about this. You have to have the engine started. If you're not generating enough passive income in real estate to support your lifestyle and give you some additional capital, or maybe there's leverage in that passive income that can create more passive income, then I say no. I say working on that active income as long as you can. Now, a lot of real estate investors have moved completely from no active income to a lot of passive income. And then they go back and they go, oh, well, now I have to add a wholesaling element, or I have to fix and flip a few houses a year for more active income. I have learned that private equity is such a greater source of active income than real estate. However, real estate is the greatest vehicle for passive income because it provides me tax strategies and consistency over time. So this is my model, and this is the model that I constantly work annually for myself. Let me make the case for why private equity now. Right now, there is from 2020 to 2022, that's where we have numbers up to. This is the end of 2022, mid 2022 to the end, is we've seen a massive slowdown and in private equity purchasing assets. So what this chart shows us is that there's about $1.1 trillion sitting on the sideline in private equity firms that cannot find yield, and they're not buying assets. So this should tell us a story, right? On the consumer side, we see, oh man, well then the market must be ripe for crash. But let me show you the opposite side of this equation. The reason that there's $1.1 trillion in cash sitting on the sidelines is because they can't find assets large enough to buy. So for me, a small to mid-cap investor, when it comes to private equity, I can go buy and I also know what their sweet spot is. Their sweet spot is something over 100 million in enterprise value. Now, they've actually increased their buy box down to 40 or 50 million in enterprise value. The greatest part about that is if I architect my asset correctly, which I'll show you in just a second, I can take a company that's doing 5 to 10 million in revenue and actually get a 40 to 50 million dollar valuation and take that cash in the sale and turn it into more passive income. We did that, I showed you earlier, 3 times that generated 91.5 or 91.7 million in less than a 10-month time period. So let me just explain this. What's happening is the PE firms, these large ones that have $1.1 trillion just sitting, these are the top tier private equity firms. This represents the top probably 60% of private equity. There's a lot more cash sitting on the table than just this 1.1 trillion. But this is the top tier. They're waiting for someone to serve them an asset that's performing and has a valuation of over $100 million. Now I said they've lowered it down to about 40 to 50 million. So let's say their buy boxes, they'll buy anything with an EV, an enterprise value of 40 million, all the way up to hundreds of millions, billions, right? And what they're looking for is performance, and they're looking for things that still have meat on the bone, right? Like that they can actually find growth out of it by infusing capital, gaining market share, strategic investments that align with assets they already have. And so that's what they're waiting on. The problem is that there's a massive gap between the small business owner and what these guys can actually take advantage of. Think of it this way. I call the big top tier groups, the private equity firm groups, whales. And how many minnows would it take to actually provide sustenance to a whale? It would take thousands and thousands and thousands of minnows. The problem with that is they don't have the infrastructure to ingest minnows. So what they need desperately right now is for people like me and other groups like myself to come in and take these minnows and grow them into mid-sized fish so that they can actually feed on it. So I can take a dental firm, for instance, that has a baby boomer as an owner that's looking at retirement. That, and by the way, this is a natural thing. A baby boomer who's 65 to 75, sometimes even 80 years old, looking at retirement, that's still sitting in the chair, in the dental chair. They have no family to pass it on to. There's nobody in the office. He's been a single dentist, or maybe he's got one other dentist. They're aging out of the practice. And they don't know what to do with this dental practice, right? Like they need to do something with it. And what they really want is they want some sort of security in retirement. They want some sort of payout for everything they've built. But in the end, you could purchase, for instance, dental practices for $200 to $1,000 to $1 million. And if you bought 2 or 3 or 4 of those and you put those together, you put together a group of dentists to essentially service those, you can turn these groups into something that has an enterprise value of 40 to 50 million, and they're willing to buy it. So you could invest 3 to 5 million, roll up some dental practices that turn into a 40 or 50 million dollar valuation, and exit in short term if you can show stabilization. people are doing this at every single level today. They're buying HVAC firms, electrical firms. They're buying dental offices, orthodontic or offices. They're doing this all over the country in every area. And there's a massive gap here for these small tier companies that need to grow up so that the big private equity firms. So what I'm doing is I'm actually buying low tier companies and architecting their growth to a place where I can exit at 10 or 15 times their value within 10. So where am I getting my deal flow? I'm getting it in 3 areas. I'm either, number one, getting it in corporate divestiture. So if you kind of see this chart there, what happens is when you look at a corporate office that right now is struggling, especially if they're publicly traded, and you've got, the largest purchaser of small businesses in the nation right now, and has been Google nationally. They have a bunch of these companies just sitting on their balance sheet, and a lot of big corporations do. However, their balance sheets look really rough today because of inflation, because of the market. And so what they're doing is it's actually a better choice. It's free for them to divest of it at a higher value and less time than to fit an appropriate path for it or fix it, right? So most of this activity that I'm seeing right now and what we've been looking at is corporate divestiture. They've got things sitting on their balance sheet and they're using business brokers to just divest of these assets that they've purchased at a high value. They're willing to sell at a low value because it's better for them to get them off their balance sheet with some cash and not have to deal with it long-term to fit it or fix it. The second thing is baby boomers retiring. This is a huge, huge opportunity. Baby boomers are retiring every single day and they're leaving, and they really have one of 2 options. They just shut their doors, which is happening by the thousands every single day. Thousands of businesses are being closed down. And most of them do not understand, a large majority of them do not understand the value they have in their business. And so they're just naturally shutting it down, winding it down and walking away. And lastly, businesses with thin margins. People that have multiple businesses today in this marketplace are afraid of the business that they have with thin margins, and so they'll naturally sell it. It's why you're seeing a massive sell-off of, for those of you in the real estate space, a massive sell-off of property management companies. Property management firms are selling, their doors to larger privately held companies, and now some big larger publicly held companies in this space, because their margins are so thin. And they're saying, wow, my construction division is doing 20% margins and my property management side is doing 5% margins. So I'm finding low margin businesses that I can aggregate and actually make more money on. And these are the 3 areas of deal flow for private equity for me today.
So Eddie, where do we find these deals? I mean, is it a website or is it business brokers, or how do you find
Yes.
each one of this?
A large majority of these are coming through business brokers. And the best part about business brokers are they're not like real estate agents. They actually play both sides of the fence, right? And they don't get paid unless the business sells. So it's actually, I find it to be advantageous to be a buyer working with the business broker rather than a seller. When I sell my business, I never go through a business broker. I actually use an M&A firm and I market it myself directly to the private equity firms. However, when I'm buying business, I use business brokers all the time. And there are tons of websites. If you just Google searched businesses for sale, business brokerage firms, businesses for sale in my area, you'll see literally dozens and dozens of sites that now have assets listed on it. Yesterday, for instance, I was looking at a site that's specifically here to Florida, and there were 4 pool companies that were ready to sell, selling for pennies on the dollar based on their EBITDA. I saw 4 or 5 electrical companies. I saw a bunch of tanning salons. I'm talking about these businesses that you can easily get into for very low cost. And so I'm finding a lot of my business deals on these sites, but then also because I've bought so many businesses, I have so many that just naturally come to me. I have some, it's like my name is top of is top of mind when it comes to this. So many people are like, oh, if you have a business, then call Eddie. So I've got more deal flow than I could ever use. We're probably underwriting or looking at somewhere in the neighborhood of 7 to 10 business acquisitions a week. Whereas I'm probably looking at less than one multifamily acquisition a week right now. So it just shows you that how active I am in this space. There's really 4 major strategies for acquisition. And for me, I always start with equity, no cash. Now, the reason that I do this is because I want, usually if the business is distressed, let me give you a really quick tip. I don't buy distressed product businesses or distressed service businesses. What I don't want to overcome is this mountain of negativity online, Google reviews, so on and so forth. What I'm typically looking for is distressed cash businesses or distressed people businesses. I can solve the cash problem pretty easily. And usually, it's not about adding more cash to the pile. It's about looking at their business from a efficiency standpoint and making the decisions that they were not capable of making. A lot of these small businesses, they're just not great operators, and you walk in and you see 20 to 30% of waste right off the bat. Even a company that's only doing $1 million or $2 million, I see waste at a very, very high level. And then also, typically the owner, the founder, is taking a very large salary, and you're removing that salary from the business as well. You're relieving it of that stress, and typically taking about half of what half to 3/4 of whatever you're paying the previous owner who's running that business to now employ a manager, and that manager is now running that business, and then we incentivize them for growth and profitability and so on and so forth. But equity, no cash. So what I do a lot of is I go in and I say, hey, I'd love to buy your business. And I am going to take and I sell the vision we're going to take their business. And what I do is I say, what I'd like to do is I'd like for you to stay as an equity owner with a long-term payout, and I'll pay you out over time, but I have no cash off the table. And I'll show you a case study of how I did this here in just a few minutes. And where I had a little bit of cash, but I used equity to kind of incentivize the sale. That's my favorite type, because what I like doing is saying to them, instead of me putting cash in your pocket, what I'm going to do is actually put cash in the business to infuse it for growth. And then you're going to be the benefactor of this growth. So take the ride with me versus take your cash off the table. What I find is that, especially for those that have already run their course in their business, they've already got an exit plan anyways. And so for them to walk away from this business with a potential of bigger upside and potentially longer payout is very enticing to them. The second thing I do is, if they're not willing to do something like that, is I have them finance the business for me, right? So what I do is I create a seller note, and we structure it in a way that we give them an advantageous interest rate over time, sometimes 4 to 6 years. And I buy this business over time, so that what I'm doing is I'm allowing the profitability of the business to essentially pay that note off over time. This would be the second strategy I always take, because again, it takes very little cash to purchase the business. I might be putting down 5% or whatever it is, and then having them finance it for me, so that I'm essentially, and then the other thing too is, because it becomes a debt vehicle, then the profitability of that company, I don't have to worry about it kicking off a bunch of cash or creating tax liabilities. Now that tax liability is being kind of extinguished by this debt, and it allows me to play inside of that space as well for a little while. The third way is SBA loans. SBA loans are fairly easy to get on acquisitions. If you have decent credit or decent track record, going and getting an SBA loan, you just have a little bit longer runway. You might need 60 to 90 days to actually make the acquisition with an SBA loan. But the SBA is very, very aggressive right now in lending to those who are going to acquire a business that potentially could go out of business or have some sort of a sunset, right? Like a baby boomer who wants to retire and walk away. The SBA is very, very aggressive in getting money out, and there's multiple different SBA programs. And you can go to the SBA website and look at all the programs for business acquisition loans. This would not, it's way harder to get capital from the SBA if you have an active business. However, if you're going to buy a business, the SBA is very, very aggressive in lending. And then fourthly, banks. I think one thing that people miss, and obviously I grew up in the banking industry, is that banks try to diversify their lending portfolio. And we all know that there's really only about 3 ways that banks make money. And the largest way they make money is deploying capital. And they always rate private equity as more risky, but higher return. And so what they're typically doing is trying to deploy 10 to 20% of their lendable capital into some sort of a private equity structure, whether it's lines of credit for businesses or whatever. And so I do on occasion use a conventional bank, usually when the company I'm buying is in a good cash position. If they're in a good cash position, like for instance, they have a bunch of accounts receivables that I can leverage or whatever, then I might go to a conventional bank. So there's 4 ways that you can really acquire these companies without just using cash out of pocket. I think most people think, oh, I'd love to buy a company, but I don't really know how to do that. And I don't really want to spend a lot of cash to do it. So the 3 big questions that I ask, and every time after selling over, I think I'm at 87 or 88 companies now, maybe I'm in the 90s, I forget now, is that I get this question every single time from the M&A firms, so the mergers and acquisition firms, right? The lawyers and legal groups that I'm using, is number one, it's always performance, right? So think about buying a business. Now I have to architect it for potential sale, right? Like I don't want to just sit and operate this business for long. What I'm trying to do is get to an equation where instead of operating this business for the next 10 or 15 years, taking that money off the table in a shorter time period. For instance, one of the businesses we just sold, at the EBITDA or the net profitability that we sold it for, it would have taken me 71 years worth of operating that business to make the money that I did off the sale of that business. And when you look at the equation like that, it's like, do I really want to operate this business 10 more years as is, or do I want to take the money off the table? Well, of course, when you get to 71 years, I don't, most likely don't have 71 years left of living. So it made a lot of sense to sell that business. But the 3 big questions I always get asked, and I always ask myself as I architect the business for sale. Number one, it's performance, and it's financial performance. Usually about 80% of businesses are valuated off of their EBITDA, right? So they're looking at your net profit. And that net profit then has a multiple of value. Some businesses, SaaS-based companies, a few other typically tech-infused companies, get valuated off of their top-line revenue, but that's a completely different multiple. They're doing 40 million in top line and somehow get $1 billion valuation. Crazy stuff out there when it comes to tech. That's not the place I play because it also has the highest risk, and it's a very red ocean in that space. It's people trying to take on Google and Uber and Apple and people out there that are very, very tech savvy. For me, I'm playing typically the valuation off of EBITDA or let's just say net profitability. So number one, I have to make sure that I'm architecting my business to generate a lot of net revenue. Secondly, the valuation and the multiple comes off of intellectual property, right? So IP. What do you do different? If you've ever watched Shark Tank, it's why my friend Kevin O'Leary says, why should I give you $1 million for 40% of your company when I could go take $500,000 and go build it myself, right? Your company has to have some uniqueness to it. Now, it doesn't mean that you have to have some special sauce or some proprietary language. What it means is you have to do something different that's hard to replicate. For instance, your data might be hard to replicate. It might be the way you do things. It might be some technology piece that you put into your business. It might be the cadence or the structure of how you do things. It might be your clientele or the contracts you have. All of that can be intellectual property. And to the degree that you can isolate and understand the value of that intellectual property, you can get a higher multiple. For instance, I had a company that was doing less than $300,000 in net revenue, and we sold at a 27 times multiple. And it's because of a small algorithm that we built in scoring the actual assets. We had a proprietary algorithm that was under the company called RentFacts. And we had that algorithm built, and it scored performance for the company. And I got a 27x or 27 times value on that company because of the intellectual property, not because of how much success it was having. It was because of the intellectual property. And then lastly, thirdly, it's the operating system. So I think sometimes when you hear operating system, you think software. It's more of like an operating model. So for instance, many of you have heard of EOS or traction or scaling up. I use what we call the Empire operating system. This is something I've created, and about 2,500 businesses across the United States are using this now. And the reason why an operating system is so important is because when you sell the business, typically the top tier of leadership goes away or has the potential of going away. What a private equity firm wants to know is there a system that I can plug leadership into where the business just continues to run without disruption? So I build all my businesses with the same language, the same KPIs, the same structures. And yes, I use the Empire OS side, which is the actual system, but the model is the important part. So whether you run on traction or you run on scaling up or you run on Six Sigma, if you're in manufacturing, all of those are very, very important, and you'll get a higher multiple because now the private equity firm knows that if they lose that top leader of the layer of management, they can plug right into it and put somebody in there that can easily be trained and operate on a systemized business. And so that's really where the operating system comes in. So I'm architecting all of this on the purchase of the company, and I'm doing this as soon as possible, right? So I'm buying a company. I'm determining its pathways for financial performance. I'm trying to determine what intellectual property or things that make me different or my chief differentiator. And then lastly, I'm overlaying an operating system. That prepares me for exit typically quicker than anyone else. It allows me to take that minnow, grow it into a mid-sized fish to serve it up to the whales. Let me just give you a quick case study, and then we'll open it up for some discussion and questions. Here's a company I bought last year. FitCon is the world's largest fitness convention. The reason I use this one is because most people say, should I just buy businesses in a space that I understand? My answer is not necessarily. We always try, and I know what happens is a lot of real estate investors, especially, I know many of you are real estate investors, you try to buy businesses that are adjacent to your company. So you go out and you buy a brokerage, or you buy a title company, or you buy some sort of a service-based company that helps your real estate, or you go buy an HVAC company or whatever. And sometimes that plays to your detriment, because you then rely on your current company to feed that new company leads and opportunity. And what happens is 9 times out of 10, that new company becomes a parasite to the old company, and it's just the host now. And what I like is creating separation and differentiation and going into new spaces, because it makes me treat the businesses completely separate and different. I taught a group of people about a month ago this same concept, and I had a guy that owned a multifamily group. He had a bunch of Class A holdings. He went out and bought a private security company. The private security company is thriving. And I said to him, how much crossover between your private security company and your multifamily? He was like, 0. And I said, how's that working out for you? He said, great. He said, now it just gave me a different area to focus on. And he said, I took the same principles by which I was running my multifamily company and applied it over there. But because there was a lack of crossover, we had to treat it as separate, and we had to put emphasis on its growth. That's a really important thing. So when I go to FitCon, I don't understand the fitness space at all. I had no experience. I'm fit conscious. I eat healthy. I work out. But other than that, I didn't know the influencers in the space. I didn't know anybody in this space. I didn't know the brands in this space. What I saw was a huge opportunity. The founder of this was a decent operator, but wasn't making any money. So let me just kind of run you through the deal numbers. So 2022 stats. They did $1.2 million in revenue. They had 31,000 people in attendance in 2 events. We actually took over right before the 3rd event. They had 3 employees total, and they did $180,000 in profit. Now, watch just the deal. So this is me kind of getting into like looking at the deal and really underwriting it. They had 300,000 social followers. They were all health conscious and love fitness. Their average ticket revenue per attendee was about $20. So if you kind of just do the math, they had about 60, or I forget what the percentages are, but maybe 60% or so in ticket sales, and the rest was all sponsorship. And I, first of all, asked myself, like, what, and by the way, these events are 2 and 3 days. What 2 and 3 day event have you gone to that only cost you $20 today, right? Like, I mean, you go to Disney World, you're spending $100 a day in tickets, and it's like $20 was extremely low. The average sponsorship was about $3,800. Now, as I looked at that, they had no additional sales items, no upsells, no merchandise, nothing. So I felt like there was huge opportunity here. I went in and I asked, I gave him an offer of $390,000. That was the purchase price for the deal. I negotiated $170,000 down, right? He said he absolutely had to have some cash off the table. He wasn't making ends meet. He needed some cash. So I get to the place of 170. Why did I do 170? Well, if you go back up to the 2022 stats, he was doing 180,000 in profit. What I was trying to do is negotiate that I put down less than what I knew I would make in profit if I just maintained this asset. He also was taking $100,000 salary. So for instance, I offered him $170,000 down, hoping that we wouldn't go above $180,000 down, so that I knew that I could recoup my investment capital within the first year. Next, I asked him to finance $220,000 over 18 months. What I knew was that they were generating somewhere in the neighborhood of $90,000 per event, and I would most likely have 4 events in an 18-month time period, which put me at about $360,000 in revenue if I just maintained the business as is. So I asked him to finance $220,000. I think I did it at 4% to him as an interest rate. I took 65% ownership into my group. I set aside 10% ownership to the new CEO, so I didn't have to pay him so much. I could let them play in the upside. And then I set aside 25% ownership to big influencers. What I didn't know about this space was all these influencers that are heavily built on, social media and Instagram and so on and so forth. And if you go back right there, these 3 guys at the top, they are on a Discovery Channel show called The Diesel Brothers. Heavy D, Diesel Dave, and the Muscle. They're all funny characters, and they are owners in the business. Primarily the guy they call the Muscle, Keaton. And then below that, you actually see another 2 influencers, Rob and Dana Lynn Bailey. Dana Lynn is the first female Miss Olympia winner, and I think she won it 4 times. She's one of the when you look at her Instagram and her social, she's one of the largest female fitness influencers in the world. And then her husband, Rob, also has a massive following, 2 or 3 million people, and he also owns a large supplement company. So we ended up granting them ownership. That's what I set aside as far as the deal structure. I only gave away about 10% of the ownership to the big influencers. I still have some set aside that I could grant more influencers. And the craziest part about this deal is that the end result of that was our average ticket price in our first event went from $20. It went from $20 to $36 a ticket. So we almost doubled our ticket revenue. Our average sponsorship went up to $5,600, and we did over $600,000 in our first event in sponsorship. We have already doubled the value of this business, and I've only owned it since last November. And I have an LOI on it today to sell it at about a $7 million valuation. Now you say, well, why would you sell it? Well, part of it is I really only wanted the data out of this company. We've generated about 3 million people interested in fitness. And since then, I've bought a supplement company, a merchandise line specific to fitness, and a proprietary testing mechanism that 21,000 doctors use called the metabolic code. All I really wanted this company for was their data. So what I'll do is I'll turn this into about a $6 million profit to our partnership, keep the data to now supplement the other 3 companies that I bought inside of this vertical, and get out of the live event space, which is always undulating. And you kind of see kind of the methodology and how I'll move in and out of deals like this. This was actually fairly easy to find people to run for me. I found a lot of people that were in the fitness space. I hired a lady that ran a supplement company out of South Florida. And I hired a big fitness influencer that was already running multiple gyms as the leader of this company out of Utah. Relocated them to Florida to where we are, and it's a viable, growing company. I put it out there for sale. We got the offer and the money that we wanted, and we actually have an LOI and expect to close on this business in the next 30 days. So that just shows you the speed at which I'm moving in these private equity firms. So I'll kind of open it up for questions and see if there's anything else. I know I've come close to the 2 o'clock hour. So James, I'm happy to answer any questions.
Sure. So let me ask a few questions because there's so many questions I have myself. So just a quick thing, who's buying? I mean, who's the person? I mean, is it like a large institutional private firm that's buying this business, or is it like a private guy buying this business?
For the FitCon company, it's this one is actually a private buyer who also owns a very, very large supplement company. A supplement company that's valued at about 1.5 billion, wants to control this space. And so he has the capital of an institutional buyer, but he is privately held. Most of the businesses I'm selling, though, I'm selling to these private equity firms. I get calls every single week right now from private equity firms saying, what other company do you have? Do you have any that are ready to serve up? Do you have anything that is mature? They're so hungry with this $1.1 trillion sitting on the sideline. They're begging for me to grow businesses and sell them to them.
Got it. And what's their motivation? Is it cash flow, or do they just want to, have
Typically it's adjacency and larger growth. So private equity firms, all they're trying to do is, get some sort of a yield to their investors. And so they're sitting on, typically hundreds of millions or billions of dollars. There's actually one right up the street from you, James, that calls me all the time right there in Austin. And they're specific to the real estate space, and they're looking for fintech, prop tech, anything technology inside of real estate. And what they want is they already have a large grouping of companies specific to real estate, typically retail real estate. And so they're looking is for companies that they know if they could buy for 50 to 100 million, they could take their massive database of retail agents and retail buyers and infuse this technology into it. So they're typically looking for adjacency to something they already have, and something with meat on the bone that they could potentially grow and get return for their investors.
Got it. So, and what is I mean, you said you like to buy from sellers who want to get, who are willing to take equity, I guess, rather than giving.
Yeah.
So how do you probe that kind of motivation? I mean, when you find a seller, I mean, let's say a business broker right now bring you a business. Is that the first question you're going to ask, or you're just going to go through the due diligence and later find how can I structure this deal?
Typically go to due diligence first. We've bought and sold enough that I have a good eye for what I like. And so we typically go after certain companies and certain types of companies that I've had success in. I love service-based companies over product-based companies because we've just done well in that space. I'm typically going straight into due diligence, signing NDAs, going into due diligence, looking underneath the covers. And then my first offer is always an equity offer. It's always, hey, why don't you go with me on this journey? And I'm usually using the leverage of my track record. Like, look, I've sold all these businesses. If I sell your business at 10 times its value, then you get to play in that upside with me. You don't want to miss out on that. That's usually the way that I'm buying them because I have that track record to pull from. But that's always my first offer.
Got it. So let me look at some of the questions you have here. Are you able to share this deck?
Sure, I'll send it to you, James.
Okay. Yeah, I can send it out to everyone. Do you invest in stocks? What strategy do you follow by investing in stocks?
I don't invest in stocks, primarily because the few times that I've tried, I feel like I can never time the market right.
You're like
Um,
me.
yeah.
Every
Well, I
time you
mean,
go in,
yeah. So what I have is I have a small portfolio of blue chip stocks that are just
okay.
sitting for 20 years. You know, it's like the Apples and I have Hewlett Packard and a bunch of just blue chip stuff. But again, if you go back to my kind of triad, it's like what I'm really focused on is generating as much active capital as I can, and then dumping that into passive income, and then trying to get that passive income as large as I possibly can to then move into my endowment and legacy pieces. And stocks just don't fit well in that triad for me.
Got it. Is there a book that you recommend to learn more?
There's a lot of books. First of all, I'd recommend this great author. His name's James Kandasamy. He wrote this book on passive income. No, I honestly do think it's one of the better books. But for me, there's not a lot of books on diversification that don't take you down the stock route. And I have a large publisher pushing me hard on writing a book on how to buy and sell businesses, because that really doesn't exist today either. Especially in these like small cap. And so I would expect that I'll have my book out on it probably in the next six to 8 months. I've already started it, and I'll get it out soon.
So next question is, assuming we have EOS down pat, what industry would you suggest we target as an emerging space? At what point would you suggest we bring a business to you for potential acquisition?
Yeah, Chris, I love that question. If you have EOS down pat, if you remember, that was the 3 things that I asked for. I said, make sure that you understand, performance, you understand IP, and lastly, the operating system. If you have EOS down pat, the one limitation to EOS, I love EOS. I actually ran 31 companies on EOS all simultaneously, is that EOS doesn't allow for true scale. EOS, the reason we use Empire is because Empire has 5 phases of business that takes you from all the way from startup or perseverance, pre-profit, all the way to succession, how to sell your business. And it's the one thing that EOS lacks. So what I would be very careful in EOS is getting anything that has multi-dimensional tiers to it. For instance, I have a coffee company. The coffee company did not work well on EOS because it had the retail shops, it had wholesale, it had the roasting side, it had e-com, and then it also had the wholesale to retail. So we're on the shelves of Barnes, or on the shelves of Whole Foods. And so EOS does not create an environment that allows for that to play well. So what I look at is, if you're really good at EOS, is look for single service or single product companies. In the emerging spaces, to me, it's really tough. Most people, they use emerging, and what they're looking for is this like holy grail unicorn. I actually go away from emerging spaces and go into more traditional spaces that I can find businesses that are not run well. And by the way, I would say a good 80% of all small businesses are not run well. If you're good at EOS, you probably run your business well. So what I'd be looking for is something that is out there, that is at a low cost, that has a single product or service that maybe you could add additional services to, but isn't really complex. And I would start looking there. And I would look at brokerage sites and just see what fits that criteria.
Is there any specific industry vertical these PE companies are more interested in?
Well, every one of them have their own vertical that they dwell in. So like, for instance, I'm building my coffee company. We're adding 10 new stores in the next 2 years. We've got a big grand opening coming up this weekend. And the reason I'm doing that is because there's a private equity firm out of New York City that only deals in the food space. And they've already told me if I can, in the next 3 years, get it to a very specific, if I can get it to $28 million in profit, that they'll give me a 10 multiple on the stores with some of the proprietary roast we have. And I could be looking at a $280 to $300 million exit. So every PE company has its own vertical. For instance, talked about the one in Austin that is specific to real estate, and they only do, they're only typically doing adjacency to retail real estate, and they're adding fintech or prop tech to it. And so really it's more about just finding the right private equity firm that deals inside of the business type that you're dealing with.
Got it. Do you have a few more minutes? I mean, we have quite a number
Sure.
of questions I want to go through, so I just want to make sure. Do you always seek a full initial control, or would consulting for equity would be a worthwhile approach?
I always seek full control because I have a model that allows me to operate typically better than most. If you're in a space though where you're close to good operators and you have a consulting model, I'm not against that model. I like that model. A lot of my friends have that model, and a lot of empire coaches that are out there do that model. So instead of taking 20 or 30,000 for an engagement, they'll take 5,000 and 5% equity or some sort of upside in the company. I don't mind that model at all. I just, for me personally, like full control because I'm a good operator. I have a good system and team to perform these assets.
Okay. So next question is that there's two questions into one. Do you usually use money syndication to raise this money, or how do you do that?
I do a couple of different ways. I'm typically not putting a ton of cash out of pocket, but on the deals that I do put cash out of pocket, I'm usually we have our own capital. However, I do syndicate periodically. Like for instance, I just syndicated, or I think we still have the syndication open on the coffee company, and we raised 5 million for the 10 stores. And we basically syndicated that to, a small group of investors. And I do have kind of a syndicate structure that we do put some of these deals out for. But for the most part, I would say less than 10% of the deals I do are actually syndicated to investors. What I am doing sometimes though, is I'll get a company that I'm performing that I know that if for instance, I'll take it to a private equity firm and I'll say, this is where it's at. And they'll say, well, we need about $10 million more in net revenue. Then I may syndicate that company out. I may syndicate out a minority ownership in that for cash to infuse it for the growth, because then we all get to play in the potential exit. And so I will syndicate midstream companies that I already have in performance. That's what happened with the coffee company.
Got it. Yeah. So, I mean, other question is recording and slide deck would be shared after this meeting. I mean, in a couple of days, we'll do that. What about buying franchisee like gym or ice cream or food restaurant? Are they good business to make money?
They really are. I would be very careful in buying anything that's more fad. Like right now, cookies are a big thing. And, so you've seen a massive surge in crumble cookie. And then a buddy of mine owns a franchise called Dirty Dough, and I think they sold 70 franchises. I would be really careful in that space because those things typically have a lifespan. I love things that have reoccurring revenue though. For instance, I love franchises that have reoccurring revenue like gyms. One of Andrew and I's business partners, Alex Rodriguez, the baseball player, he owns 2,000 gyms, and his valuation on those gyms are insane because of the residual revenue that just comes through those gyms. And so I do like franchises that have a residual model. For instance, like tanning salons, gyms, things like that. Are great franchises to own.
Great. And I think throughout the presentation, you said you don't do product and services business. Did I hear it correctly, or did you say you don't do product only?
I do product and service-based businesses. I feel like I've had more success in service-based companies.
Got it.
But I do both. What I don't do is distressed product or distressed service companies, right? Where, it's a service company and they've got 100 bad Google reviews. That's just really hard to overcome.
Got it. Awesome. All right. I think that's the questions we have. Thank you. Oh, hold on. There's more questions coming in. Okay. What's on the passing? Yeah. Should I acquire a company in order to exchange into a franchise as you exit, or even affiliate model instead of a roll up into a sale of private equity?
Yes. In the Empire system that we built and we use, in the succession plan, there's really about 10 different ways to create succession in the business, or like the exit. You could sell it, to your employees. You can pass it on to heirs. You can sell it to a private equity firm. But a couple of the strategies are you can turn it into a franchise and exit that way. We looked at that specifically for the coffee company. Like, what if we just sold the franchises and did that. But we really wanted to maintain the quality of the roasting and the experience, so we decided to go away from it. But another thing is going public today. Going public is another way to exit your company. And there's a lot of SPAC money out there. I know SPAC to some degree has these special purpose companies that are specific to taking a company public, is a very popular way to take a company public, and they may just take it to OTC or whatever. But I've taken 3 companies public as an exit, where I'll actually take capital off the table in that public offering, and then try to play in the upside for any of the share increase. And so there's lots of ways to exit your company. You can always check out Empire, if you go to Empire OM stands for operating model, empireom.com, you can see a lot of that. I think there's online stuff that you can learn about the succession plan for your business, how to sell it.
Awesome. All right. Thank you so much, Eddie, for coming and adding a lot of value to our audience. So, we're going to be publishing this on a webinar and promoting it through our social media, and also we'll be doing it on a podcast format as well.
Sounds great.
Thank you. Thank you
so much.
all. We're going to be ending the webinar. Thank you.